Yeah, that's the crux of it, right? Is if the Fed starts to see cracks in the jobs market, they could start dropping rates faster. Whereas right now, the expectations are for a lot slower than we thought 6, 12 months ago going into this year. And I was reading an article the other day that I thought was interesting, just to cap off this little piece here where we're talking about how all of these things we're talking about affect rates, right? That we're going to see the 10-year Treasury bounce around, being kind of the blue chip for where interest rates are, right? And we're about 4.75 today. We were 4.5 a few weeks ago, and so on, lower from there, going back into the fourth quarter of 24. But as far as mortgage rates, typically mortgage rates follow the 10-year. We've been talking on our desk and amongst our team, was finally reading some articles that are putting it out there more in the public that we actually could see mortgage rates rise slower than the 10-year going into this year, or just generally the spread between the rate on a 10-year Treasury and the rate on a 30-year mortgage get tighter for a few reasons. But honestly, when I think about it, the main reason is because rates are expected to remain higher for longer, which is a weird thing to think about, or weird concept, but it's because over the last couple of years, that spread between the 10-year Treasury and the 30-year mortgage has expanded. And a big reason for that is because rates were expected to go down. Therefore, more mortgages were expected to pay off. So who wants to buy a mortgage bond at 7% if it's going to pay off in 6 months when I can buy a Treasury for 4 or 5% or some other alternative instrument? But now that, as we've said on this podcast and other areas, that rates are expected to stay in the sixes for the next couple of years, that demand for mortgage bonds has gone up so that they're becoming more attractive. They're becoming a better investment, and they're paying better than a 10-year Treasury, right? Treasuries are, again, 4.75. You can still get a yield on a 30-year mortgage a couple points above that, but that spread is shrinking. Meaning if we do see rates go up from here, we see rates even stay flat from here, we could see mortgage rates dip.